Okay. Disposal or liquidation of a partnership interest. So this is where the partnership, either the partnership ceases to exist, or the partner disposes of their portion of the partnership. So it's a liquidating distribution. So they're no longer a partner. So liquidation occurs when a partner's entire interest is redeemed by the partnership. Okay, so this is not, you could liquidate it is selling it back to the partnership, or you could sell it to somebody else. Highlight that. Okay, so most of the, as it mentions, most of the rules of non-liquidating distributions also apply to liquidating distributions. So distribution of money in excess of basis causes a capital gain. If property is received, no gain is recognized, basis of the property is adjusted. So one difference is that a loss can be recognized on liquidating distribution. So you can have a loss because you're no longer going to have any opportunity to adjust that basis if you're no longer an owner in the partnership, right? When the amounts received in liquidation are less than the partner's basis, outside basis, okay, the loss can be recognized only after final payment is received from the partnership and when only money receivable and or inventory are distributed. So not if property is distributed. Okay, here we go. We've got Cassandra. Cassandra's got a basis of $20,000 in her partnership. She receives liquidating distributions from the partnership, so she's out of there. Cash of $12,000, equipment with a basis to the partnership of $6,000, so now we're up to $18,000. She recognizes no gain or loss on the liquidating distribution. The equipment, the $2,000 difference essentially is then attached and increases the basis of the equipment, right? Equipment with a basis of $6,000. So now the equipment has a basis of $8,000, so that extra $2,000, when she sells it, she's going to get that $2,000 benefit at that point. So now we've got Cassandra. She receives cash of $12,000, inventory with a basis of $6,000. Then she would recognize a loss of $2,000 on the liquidation. Cash and inventory basis of $18,000 minus the $20,000 partnership basis. The inventory would have a basis of $6,000. So if it was only cash, or if it was cash and inventory, then she gets to recognize the loss. All right, so there is an order with which distributed assets are distributed as well, and how the basis is affected. First, you reduce it by any money that was distributed. Next, any receivables or inventory, and then the rest is any other assets. Okay, so Kelsey has a basis in her partnership interest of $10,000. She receives the following assets. So $3,000 cash, $2,000 inventory, $2,000 equipment, $4,000 land. All right. So what they do is they allocate the assets based on the proportion. So cash is, let's see, so we have here 5, 6, 7, $11,000. So $1,000, she's $1,000 short. That $1,000 is essentially spread over between the equipment and the land. So the equipment, so these two are $6,000 together, and they're $1,000. The basis adjustment is going to be spread between the two of them based on their proportional basis. So yeah. Okay, so that is a liquidation of a partnership interest. All right, so what happens when you sell a partnership interest? So this is, the partnership is getting them out with the liquidation. You're gone. The partnership's going to buy back your share. With the sale, you're selling it to somebody else. So it's similar to the sale of any capital asset. Partner determines the amount realized from the sale and subtracts the basis of the partnership interest after that date. It is a capital item, and it's reported on Schedule D, just like any other capital item. Okay, so here we've got, what are we doing here? Okay. Jana purchased a 30% partnership interest for $23,000 in February 2019. Her share of the partnership income was $12,000, $15,000, $8,000. She made no additional contributions or had any other withdrawals, so her adjusted basis is, let's see, adjusted basis, so that's 23,000 plus the 12,000 plus the 15,000 plus the 8,000. So her adjusted basis is $58,000 in that partnership. She sold it for 74,000. So she has a long-term capital gain then of the difference between those two of $16,000. So if they receive, if as part of the sale, they receive appreciated inventory or accounts receivable, then they have some ordinary gain. Because remember, that's an ordinary asset. The partnership interest is considered a capital asset, but any of that inventory or accounts receivable are considered ordinary assets. Okay. Idea behind that is that if they actually sold those items, they would have to recognize ordinary income, right? So here we've got the same facts. Partnership has uncollected accounts receivable with a fair market value of $20,000 and a basis of 0. Her share in the receivables is $6,000, her 30% interest. $6,000 of that $16,000 gain would be ordinary. The other $10,000 would be capital gain. Okay. All right. So let's take a quick look at this comprehensive example. So just so you can see where everything would show up on the 1065. Okay. I guess first, does anybody have any questions about the liquidating and distributions and disposal? All right. Oh, excuse me. Okay, 60-40 partners, 2 partners. David's got a distribution of 60,000. Robert received 40,000. Here is their balance sheet, the beginning of the year and the end of the year. All right, this is their financial account and balance sheet. Here's their income statement. Revenue, expenses, salaries, guaranteed payments. All right. So we can divide up the items that are ordinary and the ones that are separately stated. So ordinary items would be the consulting income, salaries and wages, the guaranteed payments. The 179 expense also affects ordinary income. Interest, taxes, so we make adjustments. Now here, they're assuming that 50% of the meals were allowed. Now remember, in 2021, you actually could take 100% of the meals for tax purposes, but they're assuming 50%. Insurance, accounting and legal, payroll penalties, not deductible, remember, but they would be showing up on the financial statement and would end up being part of the income statement and the balance sheet. So these are the separately stated items: interest, dividend income, capital losses. The guaranteed payments are both, remember, and the 179. Oh, I'm sorry, this is the depreciation, and then this is the 179 portion of the depreciation. And then charitable contributions are separately stated as well. So let's see where everything would go. The 554 goes up here. So their total income, 554. Wages, guaranteed payments show up there. All of those other ordinary items, the depreciation, including the 179, ends up there. So their ordinary business income is 95,776. They went through and answered all these questions. No, 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 no. They did make some 1099, so there's that question about 1099 payments. Now here are the separately stated items. So the ordinary business income shows up here. So this from line 22, 95,776, carries over to line 1 there. No rental income or anything like that, but we do have guaranteed payments of 196. Interest income that we saw up there, dividend income, qualified dividends, all those are qualified. Long-term capital losses, section 179 expense. Remember that was part of the depreciation, but the 179 is pulled out. Contributions are listed there as well. Net earnings from self-employment. So we would have the 196. This should be, let's see if they did this one right. If we can get to that amount that they've got there. So it'd be the 95,776 plus 196 minus 5,000. 286,776. Okay, so our ordinary income minus our plus our guaranteed payments minus our section 179 gets to our earnings from self-employment. Non-deductible expenses were 6173. So those are like the meals, the penalty. What else was included in there? Half of the meals and the penalty. So 5673, so it should be 60, was it 6173? Yep. And then distributions, $100,000 of distributions. They mentioned that, where did they mention it? Oh, David received a distribution, 60,000, Robert, 40,000. So there's the distributions there. Balance sheet, this is the balance sheet. Everything is entered from the financial statement. So we've got that whatever was up here on this balance sheet, right here, all of this gets entered on the tax return. So 433,567, 433,567. So you see we've got 2 years worth here. We've got beginning of tax year and end of tax year. So essentially this is the end of last tax year, right? And so all of this should look exactly the same as that financial statement balance sheet. This is the adjustments. Net income per books, guaranteed payments, travel and entertainment. This is 1/2 of that, 277,306. So income or loss, let's see, 277, is that what we got? That was 95. Where did they get the 277? Interesting. I don't think they did their M1 right. Analysis of net income, subtract line 8 from line 5. Loss from return. Oh, so the 277,306, 95,776. Let me get the difference between those two because I think that's just an adjustment item. Minus 277,306. 181,530. I don't know what that difference is. There's probably a depreciation, maybe a depreciation difference. Interesting. 181,530. 30. Well, part of that is the guaranteed payments. I don't know. I can't tell you. All right, so and then this is where this is what the K1s would look like. So here we've got Roberts, he's a 40% owner, and then we've got David's, who's a 60% owner, and all of those items on Schedule K are going to show up then in their percentages, their ownership percentages on their K1. Okay, this puzzles me. I'm gonna have to look at that. So that's where everything would show up. And that's the chapter.